Good morning. Sound check in the back. Everybody can hear me? Thumbs up. I heard a little round of applause. That's pretty good.
That's pretty good. Yeah.
Really thrilled to be here, everybody. Good morning. Thank you for MFA iConnections for having us. We have an awesome panel this morning to get the LP perspective. We have three fantastic panelists, Mario Tarian at CDPQ, Darren Wolf at Aberdeen, and Derek Drummond at the state of Wisconsin. So we have 30 minutes. We'll blink and this will be done. But if we could just start with a quick introduction of your firm, how you think about investing in hedge funds. We'll talk a little bit about the diligence process, and then we'll talk about the fun stuff in terms of opportunities and where you guys are excited about investing. So Mario, I'll start with you.
All right. Thanks very much for having us today. Great to be here in New York City at iConnections. Mario Tarian working at CDPQ, which you'll see is going to be rebranded allocate. So coming very soon, you'll see that. It's a $475 billion Canadian dollar plan based in Montreal. Typical Canadian model where close to 80% of the investments are done internally across all asset classes. So I'm responsible for the external portfolio management team, and the program essentially in hedge funds is investing in these low beta or low correlated strategies with the typical 60-40. So,
great. Darren, to you, please.
Sure. Hi, everyone. Thanks for having us here today. Darren Wolf, I'm the head of multi-asset investing for Aberdeen. Aberdeen is a London Stock Exchange listed, about $500 billion asset manager. The multi-asset business is comprised of a few different sub-businesses. The hedge fund business, which I'm here to talk about today, we allocate about $16 billion externally. It's entirely comprised of custom portfolios that we build for large investors. So we're really always pretty opportunistically looking for all sorts of strategies. We have certain mandates that are higher expected returning, certain that are lower expecting returning, and really everything in between. As far as what we tend to look for or how we tend to look for things, we really don't have much of a heavy top-down approach for trying to decide which strategies we want to be invested in when. Obviously, we spend some time on it, but really it's a when you see it, you know it type of thing. It's a very fundamental, bottom-up, hand-to-hand combat type of approach to sourcing managers and vetting them. We have, let's see, probably about 90 different hedge fund relationships, and like I said, about $16 billion.
Great. Derek, tell us about the state of Wisconsin.
Yeah, no, I'm Derek from the state of Wisconsin. We're kind of CDPQ's smaller cousin. We do a lot of similar things. We run about 50% of our assets in-house, and basically how it works is our asset and risk allocation team tries to build the absolute best beta possible, and then they get a risk budget, and they give us the risk budget to be able to go and allocate capital where we think we can generate the best risk-adjusted return over the market return. So hedge funds, so we run our beta 1 equity, beta 1 fixed income, and our hedge fund portfolio, which is ported on top of that beta, and then our benchmark is whatever it costs to kind of lever up the firm. So SOFR plus to invest in a hedge fund. So we can kind of expand or contract our portfolio based on the opportunity set.
Right. Derek, I'll stay with you, and then we'll work back across here. There might be some managers in the room who either want your capital or are existing partners of yours, but could you just talk to the audience a little bit about what it means to be a partner for you, what it means to manage capital on your behalf?
Yeah, so I mean, we do a little bit of everything, right? So we'll seed managers, we'll do GP stakes, we'll have large strategic partnerships. It really, what it means to be a partner really, is a spectrum. What I say is what we don't do is we don't get a check in the mail or a statement in the mail and we're quiet and passive investors. We want to know what we own. Our analysts are highly incentivized to generate the best risk-adjusted return possible. So if we're going after a smaller, newer manager, and we're seeding them, maybe we take some seed economics or something like that, but we help them grow. We give them insights as to what other investors might want. We give them access to different service providers. We literally are doing like helping them, grow as a business and do some, business development. If it's a real large strategic partnership, what you find is groups like our size, everyone kind of pairs off with different groups because a large asset manager can't have 50 of these relationships. So we select 2 or 3 groups, 2 to 5 groups. Usually it's one per, sub-strategy, so say credit or something like that. And then we set up a relationship with that manager where we don't want just the stock, the stock return. If we're gonna have a big relationship like that, we want knowledge sharing. We want to share your risk systems. We want you to come and teach our internal teams, show our internal teams deals. We want our internal teams to be able to go and sit on your desk for a month and a half. And we want to be the first call when something interesting comes up. Now, we get that requires us, they can't keep calling us and we keep saying no. We have to allocate capital, we have to commit capital. And those are large, long-term relationships that are hard to extract yourself from. So Mario and I, talk about this regularly. How do you get the most out of those relationships? And that's what we spend a lot of time on.
Right, makes sense. Darren, just what does it mean to allocate to a manager from Aberdeen's perspective? What are you like as a partner? Are you calling them for weekly prints and moments of volatility? What is it like on your side?
Yeah, I mean, we're really close to our managers. I would say we want our managers and our relationships to view our engagement as a partnership the same way that we view it as a partnership. And that means, obviously when times are tougher, to be entirely transparent and communicative. Obviously we like to know everything that our managers own. We do a lot in separately managed accounts, so that affords us the ability to know what they're investing in along the way, so that when we have our regular engagement, our monthly calls, our quarterly calls, our annual, re-underwritings, we're not starting from a position of like, what's in your portfolio and what's your biggest position, what are the winners, what are the losers. We generally have that data already, which kind of affords us the ability to have much deeper and I would say more meaningful conversations about strategic direction and high level, direction of the firm, the portfolio. We do spend a lot of time with our managers pre-investment. We have a fundamental view that one of the, if not one of the biggest issues when investing in hedge funds is not that you miss something in your initial due diligence stage, rather you invest in something and it maybe slowly turns into something else over the life of your investment. So, obviously staying really close to the managers, talking to them every month is really important, but I would say that's how we like to engage.
We talked on our prep call last week and you mentioned the speed at which institutional LPs allocate. Would you say that's slower today, faster today? Do you have to be a little bit more dynamic and nimble when an interesting opportunity comes up? Could you just comment on what you're seeing from your clients?
I would say for our business specifically, it feels like things are slower. Not necessarily in a bad way. I mean, you always obviously want to raise the capital yesterday, but it feels like our business, because it's customized, our first conversation with a client usually starts out with, what type of problem are you contending with in a portfolio that a thoughtfully blended portfolio of hedge funds can potentially look to address? And so that's usually the beginning of a conversation. But even before that happens, they have to make the determination that they want to allocate to the asset class. I refer to it as an asset class, even though I don't consider it an asset class, but you have to make the decision to sell something to buy something else. And to the extent you make that decision, from that point, it could be a pretty extensive process.
Mario, case as we'll soon hear CDPQ go by shortly, it's evolved a bit as an institution, right? You're very focused on uncorrelated alpha, low beta. Could you just talk about, from your perspective today, in your seat today, from the external funds perspective, how you're thinking about allocating? And similar question to you for the GPs in the room, like what does it mean to be a partner with you and your team?
Let's go over a couple of things. First of all, we try very much, like Derek mentioned earlier, we try to be an LP plus, right? We're very active with our managers, and this is stated like before we do any investments, of course. We try to see how we can work with our managers. We are in the business of insights. So our team, the people that work with me are in the business of insights. We need to bring these insights from the outside in with our internal teams. So that's really important. So whether it's risk management, whether it's currency hedging, whether it's macro intel, whether it's cyber security, AI. So to give you an example, we've been working for the last couple of months. We've kind of been doing this big reflection on AI and the AI stack. So we have some long-only guys, some private equity guys, some VC, some hedge funds, and we go around, with a small working group, and we try to really understand how do we benefit from the investment side, across sort of that stack. So, and we use our managers. So it's really important for us to bring sort of these managers inside. We organize all of our partner, well, not all of them, but the biggest, what I like to call a connectivity plan. So for each of these managers, like from the get-go, when we start the year, we have a list of objectives with them. We have KPIs. We review it with them. So that's always it's very, very formal, I would say. We try to do it, in a very deliberate fashion. Now, on the hedge fund side, the way we've been allocating, especially in the last 3-4 years, I think that we've been more and more inclined to have managed accounts, and that trend is going to continue. And I would say one of the big game changer for us was we're an overlay activity. So we borrow from our treasury and we invest in hedge funds. So we're sensitive to interest rate payments that we have to do on that. So in order for us to be cash efficient, we've been establishing this platform where we try to put our macro CTAs, market neutral funds, to be able to benefit from this diversification that's baked into our portfolio construction. And it makes a big difference, I would say. Instead of borrowing $100 at 4.5%, we borrow now 50 or 60 cents on that dollar. So I think it's really important for future GPs that we approach, that they have this in mind. And we do this in a way for us. We're comfortable and confident about our manager selection skills, and we're not trying to deconstruct or do like what a pod would do. But I think that we're quite confident that the economics around what we're trying to achieve are favorable for us.
So Darren said something interesting, which is intuitive. They do a lot of pre-investment work, and you're trying to understand how that investment evolves, and is it doing what you initially thought it would be doing? And you said something interesting last week was to your analyst team. What data points are you looking at to come to me to say, hey, I think we might redeem from this manager? And don't just come to me saying there's style drift, because that's an easy way out. Could you just comment a little bit on that? What do you look for? What do you think about that?
When we started investing in this business, like when we made our first investment in hedge funds almost 25 years ago, we used to receive sort of the monthly NAV. Sometimes, if you're lucky, you get the weekly one, and we were just evaluating a manager on that the quantitative metrics. I think that the world has changed. I think that now we have the tools and the technology and the data to debunk the narrative. Is this manager lucky or good? And I think that this is really, really important, since we don't have a lot of access sometimes to the managers. So we do a lot of that. We've built applications, systems, technology to help us evaluate the real data, the facts. And we first started doing this in long only, like many, many years ago. We've had managed accounts, and I thought this made us like a very good investor. And now bringing this over hedge funds, especially the strategies that are probably less complicated, like equity market neutral, long short CTAs, some macro, not all of them, is much easier.
So let's turn a little bit to hedge funds very specifically in the opportunity set. Derek, I'll turn to you. There seems to be more dispersion, lower correlation. It seems to be interesting opportunity set for hedge funds to outperform, which I think a lot of us in the room will like to hear. But do you think hedge funds are set up ex ante to outperform on a go forward? What is your view? Are they still additive to your portfolio? Could you just comment on the broader opportunity set?
Yeah, I think, I mean, I'm talking my book, obviously, but it's, I mean, I think we're back, you know, in the early 2000s version of hedge funds, right? There's dispersion. Anytime you get disagreement in the world, you know, that creates the fuel. It doesn't create alpha, but it creates the fuel for alpha. And you gotta have the right players on the team to be able to capture that opportunity. But dispersion, volatility, you're getting regional dispersion. You're getting dispersion by product type. You're getting different buyers and sellers are just behaving in sometimes uneconomic ways. Like that all creates opportunity. And what we're seeing is, I mean, this opportunity set I don't think is going away. And there's something, you know, there is a correlation between higher interest rates and volatility and dispersion. You know, if cost of capital is high, a good company can do better and a poor company will do worse. And like, that's good for security selection, right? So we think this will stick around. We don't think we're going back to zero interest rates anytime soon. We think there's going to be a lot of volatility out there. That doesn't create alpha, but creates the opportunity for it. And so we've been increasing, you know, we think we can do, you know, SOFR plus 300 to 500 basis points. And when you're looking at other things, I'm not sure that the illiquidity premium, you're getting paid enough to lock up your capital 7, 10 years, and you have liquidity, and you have transparency, and generally it's, you know, fairly uncorrelated. If you're doing it right, it should be uncorrelated to market betas and things like that. So I think hedge funds, whether it's in portable alpha or in the asset allocation, has it on a go-forward basis is a real interesting lever for people to use in their portfolios. That hasn't been that way in quite a while. What we have seen is that money's flowed out of hedge funds over the last year to 2 years, and that's mostly because I think their illiquid book, they're not getting liquidity from there. They, you know, they've had to rebalance out of hedge funds because they've done quite well. So that's creating capacity and things like that for people who can, you know, take advantage of that. But I would have suspected that the hedge fund business would be increasing in size, not decreasing.
Darren, any thoughts on hedge fund outperformance? Are you bullish on the space? Would you continue to be one in, one out broadly in your portfolios? What's your view?
Yeah, I mean, I would say Derek made a really important point. So first of all, expected returns across hedge funds have definitely gone up. I think interest rates is probably the single biggest driver, and then volatility, and then I would say in general, lack of clarity or visibility. I mean, the point that Derek made, like hedge funds tend to, you know, root around in the more confusing or complex or you know, controversial areas because that's what creates opportunities. And so in absolute terms, higher level of rates, higher level of vol definitely leads to higher expected returns across hedge funds. But beyond that, I know our internal macroeconomic team has 60-40 5-year returns at something like 6 and change %. So if we have, you know, cash plus 3 or 4 or 5 as expected returns across hedge funds in an uncorrelated and diversifying way, we feel, I know I'm like preaching to the choir here, but our general view is that not only in absolute terms are you getting the returns that you need, but obviously also relative to your alternatives. In the decade from 2010 through 2019, that decade, the Sharpe ratio on the S&P 500 was higher than it has been in any other decade over the last 7 or 8 decades, I think in like, yeah, probably 70 or 80 years. So that meant investors had to choose. They either had to choose something that would be diversifying relative to equities, or you have to turn up the risk so significantly so that you're not a drag on passive equities, which are already delivering pretty attractive risk-adjusted returns. Now we're back, and this is a point that Derek made, we're now back to an environment where investors aren't being put in a position where they have to choose between diversification and expected return. We're in an environment where you can get high single-digit returns with diversifying properties.
Mario, you guys are very busy putting a lot of money to work. Are there enough talented money managers out there to take your money? Are you finding okay managers that are passing your bar, but maybe just slightly. How are you thinking about the opportunity set and allocating to hedge fund managers?
Yeah, I was going to say, I mean, I'm bullish on, I like the hedge fund space right now from a bottom-up, dispersion, companies credit, but also from top-down where you have dispersion amongst countries from monetary policy to fiscal. But at the same time, I mean, hedge funds, I mean, you could buy a hedge fund beta, right? But we're not looking for hedge fund beta. And it's not like, I like Europe, I'm going to buy the index, right? Or I like the S&P, I buy the S&P 500. So I think ultimately this game is about manager selection. It's a zero-sum game. Skill comes very, rarely, I would say. You need to find skill. I think there's a finite, skill-based type alpha that's out there, and this is where you need, it's not a strategy for the tourists. You need to have the teams. You need to be able to source. You need to have the network. You need to have people that are on the ground. You need to be able to evaluate these managers before you invest. You need to have good governance. You need, all of these elements, right? But ultimately, it still remains a strategy that's skill-based, and sometime also one could say that this strategy is a very idiosyncratic. Not a lot of succession, I would say, attached to the skill. So it makes it a finite strategy. So you need to, churn the managers and things like that. So
you mentioned overseas, and we're in the center of finance here in New York City, and maybe we forget there's a big, broad world out there. We talked about Europe, we talked about Asia in the news. There are markets doing well year to date. I think the S&P is now up 2 for the year, so we're in positive territory. But are you guys finding more opportunity set overseas, in the US? I'd love to talk down the road, starting with you, Mario, just on the international opportunity set.
I think the US is still a place where you see the most depth, I would say, like several generations of managers. You have the big pods that are here, people coming out of these pods. But I think also what you're seeing in Europe and Japan, for example, or Asia, it's a more mature market. Like 20 years ago, we used to look at these markets because we were thinking about diversifying, right? Diversifying alpha. But ultimately, you need 2 things for alpha. You need skill and dispersion. And you might be the most skillful manager in Europe, but if there's nothing to do in Europe because there's no dispersion, because the market is kind of frozen, there's not much you can do. But interestingly enough, we're seeing now this year, like the event calendar in Europe really being more dynamic. You're seeing all of these things happening in the financial sector. You're seeing divergence between macroeconomic policies between Germany and, let's say, the US or Europe and the US. Same thing with Japan. So I think it can be a more fertile ground. So we're spending time there.
Darren, from your perspective, are you taking a bottom-up market view on a specific geography to understand if it's worth it to spend the time, or how are you guys and your team thinking about international opportunities?
Yeah, so just to echo Mario's point, we're still seeing a ton to do in the US. Maybe the beta opportunity is not quite as attractive, but alpha opportunities we think are really interesting here globally. There's just a lot to do. There's, I guess, it's a good problem to have, but there's a lot of chaos going around in the world right now, which means there's a lot of, like, the spectrum of investment opportunities is pretty robust. As far as like what regions we look to, what we try to, obviously Mario's point about dispersion is an incredibly important one. And to the extent we find asset classes or regions that naturally over time have a lot of dispersion, that lends itself to our ability to find managers that can outperform, generate alpha. Manager selection can really add value. To the extent there's not a lot of dispersion, we try to go elsewhere. Large cap US stocks, there are definitely ways to make money there, but there are so many eyeballs on that segment of the market that it's a little bit trickier to find somebody that can consistently outperform and generate alpha. I'm not suggesting to any large cap U.S. equity managers out there that it's impossible to raise assets. It's obviously not, but it's harder. Not as much dispersion. Many players out there, but I guess that's our approach. See where there's consistent dispersion, and that's where we cherry pick for managers.
Derek, are you on a plane overseas more now than you have been in the past few years, or is it pretty steady state for you?
So I would say, I mean, we're always in Asia twice a year. We're always in London, probably 4 times a year. We've always had investments in Asia and in Europe. Now, last time I was in London was probably a month ago, and it's palpable. Like there are managers are excited, similar to what Mario said. Like you don't want just diversification for diversification's sake, right? Like the alpha opportunity has to be there too. And now it really does feel like there's a true alpha opportunity, whether it's, I think this morning Canada just said they're upping their military spend. I don't know if they're gonna buy US planes. They're probably gonna buy French planes or something like that, right? Like there are things going on in Europe that are structurally different than they were 6 months ago. And we think that's gonna persist. And when you have good, strong athletes on the field in those areas, like the opportunity should be better. We're seeing the same thing in Japan, like Mario was saying. There's structural changes in these markets, whether it's Korea, Japan, where we think if you have skill and you have the right players on the field, like you can capture that, and you're getting some of this non-correlation to your U.S. book these days, and that's very valuable. We have not gone to South America yet, but you see some of the large platforms just announced recently over the last couple of weeks. They're going to South America. Schoenfeld just opened an office. I think we actually just had a call with B of A. Your team, banks are putting resources on the ground in South America too. There are things to do. We don't understand the space. We haven't been invested there yet, so we need to do a lot of work and understand who the players are. It's going to take us a while to get there, but we're starting to put some things in motion to understand the market better and figure out who the partners we want to partner with are.
You mentioned some of the larger managers. I think it's a trend we've all seen, and we have a couple minutes left, so I'll ask you to keep your response here relatively brief so we can maybe get one more question. But we've all seen some of the bigger managers get bigger, right? Mario said it's a zero-sum game. You're all competing, in a sense, to identify alpha opportunities. So, Derek, I'll start with you. If you're not invested with some of the biggest managers out there, like, what do you do, right? How do you compete? What are you telling your team? Is it a grit and hunger, determination story? Is it you're smarter than them? Like, how do you guys think about that?
So I've gone through all the stages of grief on this because we don't own maybe 1 or 2 of those, but I think there was a study last week that said 60% of the assets are with the top 50 managers. And of that, I would say it's probably even more top heavy than that, which also means we all own the same thing, which is a little nerve-wracking. And so you're like, okay, well, so then I go to my team and say, well, this makes me, but they're 2-3 sharp businesses, right? And so whatever I'm not long, I'm short. And so I need to go find something that can help me either build a 2 or 3 sharp, by buying the pieces, or something. 2 or 3 sharps are very, hard things to find. And alpha is a zero-sum game, as Mario was saying, right? So I think if you're a smaller institution, you might have to play that game. I think it's a lot of work and to play a game where you're going after the pieces and building it together, but that's kind of our job, right? And I do think that there are some leverage and structural issues at those large firms. They're putting up phenomenal numbers, so and they're great risk managers and things like that. But we've decided to kind of go about it a slightly different way and buy the pieces and then partner with groups and get to that 2 or 3 sharp maybe a different way, through rev share or helping firms grow, going with smaller managers that might be a little bit more nimble, providing structural, helping seed a new product for a manager where we get better economics or a better look at certain assets and things like that. So it's a lot of work though, and you need to have the team to be able to go and sleuth out those opportunities, and then it comes down to portfolio construction. And like if you go with one of these big shops, it's kind of like, portfolio construction in a box a little bit, because you're trusting them that they've done the work to build the risk infrastructure to keep you safe. My biggest issue with some of those groups is like, I don't know the risk takers when I go into one of those firms now, I don't get to meet the key risk takers. And so I don't really know what my risk is.
We need to wrap shortly, but Darren, any comments on that, and Mario to wrap?
Yeah, just one last comment. I mean, so the top 50 represents 60% of the assets, and those large brand name managers out there that have produced those exceptionally good Sharps for a really long period of time, of those top 50, it's probably really just the top 4 or 5. Beyond that, they might be big, they might be really good, but their alpha proposition might not be that different from maybe smaller managers that are also really good. So it's, you know, in our mind, what we've seen, it's like that top sliver that are the biggest, that are the best, that if you have an allocation, stay there. But beyond that top 5, 6, 7, 8 managers, the alpha can be recreated or replicated through, fee arrangements or rev shares. Or
Right. Mario, we'll wrap with you, and then we'll call it a morning here.
Very quickly, like Derek said, this is very hard, as it should be.
Yeah, good point.
I love it. We're at time here. I really appreciate the time this morning, gentlemen, and thank you, everybody,
Thanks.
for listening this morning.
Thanks.
Thank you.